Welcome to My Talk, the podcast series brought to you by ISS Market Intelligence. Thank you so much for tuning in. The focus of our discussions on the My Talk podcast is the marketplace and its many aspects, many subsectors: asset management, wealth management, life insurance, banking, fintech. We love them all. For more than 3 decades, we at ISS Market Intelligence have been passionate students of this business. And our mission here on My Talk is to peek behind the industry headlines and just try to kind of lift the veil a little bit and try to dissect some of the developments in the business around the world with the help of industry experts and thought leaders. Episodes are monthly, sometimes more frequently if we have time, because we do have day jobs as well as researchers here at Market Intelligence. But if you do enjoy this episode of My Talk, please remember to subscribe to our podcast on your preferred platform of choice. My name is Goshka Folda. I'm your host and Global Head of Research at ISS Market Intelligence. So those of you following this year's My Talk series, you know that throughout the past several episodes, we've kind of done a world tour and focused on the sales environment for asset management and for investment funds specifically, and took a bit of a global view of what's going on right now. And clearly, the sales environment for investments and investment funds at large is not great. So now we are going to, in this episode, we turn our sights onto the future, understanding that right now we're living in a bit of a challenging macroeconomic and market backdrop. What does the future hold for the asset management business? And joining me today to discuss this topic, and he will by joining today, he will actually claim the ribbon for the most appearances on My Talk, is my colleague and friend, Christopher Davis, Head of U.S. Fund Research at ISS Market Intelligence. Christopher is fresh off from putting the bow on our annual State of the Market report, which we lovingly refer to as STOM, focused on the future of retail products in the U.S. asset management business. Welcome, Christopher.
Hi, I'm glad to be a repeat guest. I hope to never relinquish my award as most frequent guest.
Absolutely, Christopher. You always have fascinating things to share with us. So, Christopher, there's just so much to discuss. The report is chock full of interesting ideas. So let us jump right in. We understand that no one can see the future perfectly, but tell us how you put together the forecast and some of the thoughts and the key drivers that you considered as you were building this.
Well, one thing I want to make clear is that, this isn't just an exercise in extrapolating historical trends forward. If we did that, our job would be a lot easier. We would just look at the data, see what's happening, and say that's what's going to happen over the next 5 years. It'd be data sets that we have at our disposal. We use publicly available data such as market forecasts, data available from the Federal Reserve on the health of U.S. households to get an understanding of investors' wherewithal to invest. And we also consider, we look at historical trends and we consider whether they're going to accelerate, decelerate, stay the same. We think about new innovations that might make the future a lot different than the past. We put all this together. We put our heads together, collect our insights from wherever they lie. And, so this year, we came up with an outlook that actually points to a decent, if not necessarily spectacular outlook for asset managers. In absolute terms, we think long-term funds are going to grow about 12 trillion in assets over the next 5 years, which is a pretty healthy pool to swim in if you're an asset manager. So Um, we do live in a challenging sales environment. We expect that to persist through this year. But beginning next year, I think you should see, a healthy sales environment. The past five have been kind of an unprecedentedly terrible environment for sales. And so, that's very unlikely to persist. We think things do, return to average, even if the average isn't great, a um, return to average when you're at where we're um, return to average when you're at where we're at now constitutes an improvement.
Yeah, that's a great point. That and actually, when you think about that kind of top line of $12 trillion in growth in assets under management for the U.S., that's a very impressive number. And you mentioned new innovations. We'll return to this topic in a couple of a bit later. But with respect to that kind of growth opportunity, who are the likely winners and losers? From from where you stand at this moment?
Well, some of the winners are some of the same winners we've articulated in years past, at least when you look at things from a very asset under management perspective. One winner we see is bond funds. This has been kind of a perennial view of our this has been kind of a perennial view of ours given the demographic factors at play. But last year we saw record outflows in bond funds. We saw historic outflows with interest rates creating a different dynamic that we had never seen. I should say, never seen. Many investors had never seen. A situation where equity and bond markets were falling at the same time. So it was kind of a revelation to a lot of investors. And a lot of times these kinds of um, slow recovery and flows, um, it, but we think higher interest rates in a more normalized environment will bring bond investors back into the fold. The demographics argue for that as well. The remaining baby boomers will be moving into retirement over the next 5 years, and that's a very powerful impetus. Another one that we've been thinking about as well is the impact of higher rates actually being a detracting factor from equity fund flows. Investors have held equities to make up for the shortfall that low rates cause in investor portfolios to come by holding bonds instead of trying to goose returns with stocks. So we think that's another headwind that equity funds will have. And as far as losers go, in a similar vein, not only do we see equity funds seeing outflows, especially U.S. equity funds, we think this persistent trend in U.S. equity, active U.S. equity funds, seeing outflows will continue. That has something to do with the aging demographic. A lot of the people cashing out today disproportionately hold active funds. They bought Fidelity Magellan in the 1990s, for example, when it was hot. Their holdings remain actively managed to this day, but they're kind of the ones cashing out. So that's one reason, and something also other factors that we do explore in the report in greater depth is the impact that vehicles like SMAs and CITs have had. They've accelerated. Adoption has accelerated in recent years. And what we have found when mutual funds, especially because it represents a permanent change in how investors are building their portfolios. It may be that they've chosen to index their portfolios rather than keep them active. Once you go index, you rarely go back. And SMA similarly, you purchase an SMA for a particular reason, probably from a tax management point of view. And if it makes sense for you today to hold an SMA, it's probably going to make sense for you to hold it tomorrow. And we see the kind of the last bulwark that the active mutual fund industry has hung on to space. ETFs, are not held or cannot really be held in a defined contribution account. So that's been one protection, but we've seen collective investment trusts or CITs taking a lot of share, undermining the traditional mutual fund business. In fact, there are now more CIT assets than fund assets in DC plans. DC or target date funds, which are the bulwark of the DC space, are seeing outflows in the mutual fund space, but inflows in the CIT space. So we see threats beginning, though, that from an asset under management perspective, um, it's easy to identify the winners and losers. We have to take a step back and think about really what matters. Of course, assets do matter, but the only reason they matter is because assets um, generate fee revenues, and fee revenues are what um, power all managers' economic fortunes. And from an economic standpoint, the situation isn't quite as bad for active managers. In fact, even though we've seen dramatic losses in market share over the past 5 years, from something like 60% to 50%, active funds still generated almost 90% of the industry's total revenues, and they'll generate about 84% of all of the industry's revenues. So when you take a step back, you see that the AUM picture doesn't accurately reflect the industry's true financial fortunes.
Yeah, those are so many important points, Christopher, in there. And clearly, I encourage everyone to get a report and read it, because your point about revenues is so well taken, that there is still a very high percentage of the kind of, you mentioned 90% plus of revenues that are tied to the active side of the book of business. Also, there are also some kind of, at the backdrop, Christopher, I guess there are some mitigating factors. In that kind of constant erosion of the share of active. Let's see, depending of how the markets go, the beta replication strategies might suffer, because I think that they've really come into in the post 2009, first a little bit of a bump after 2002, but then post 2008 and 9 fiasco, when the bulls were running for a better part of 12 or 13 years. So let's see how that unveils in the coming years. But are there that you'd like to highlight, some myth breaking or some out there ideas that we're putting out there?
Well, if you read the financial press, probably for the better part of 2 years, you read constantly about how asset managers have been bulking up their alternatives capabilities. There's been a lot of enthusiasm for alternatives, and for good reason. Um, Often investors, as I alluded to earlier, have relied on bonds for diversification. They don't behave like stocks, so bonds are a great foil to stocks. But if we live in an era where that's not the case, alternatives make more sense. But I would say one of the biggest changes from kind of our historical forecast is, we have pretty modest expectations for asset growth. For liquid alternative mutual funds and ETFs. In fact, other than standalone allocation funds, your standard 60/40 type of funds, which we have the lowest expected growth rate, alternatives are second lowest. And a departure from industry consensus, not in the sense that we think alternatives are, primed for poor growth, but we think a lot of the growth is going to happen outside of the traditional fund structure. And 2023 has kind of bolstered our conviction in this. We see investors kind of running away from a lot of these, traditional alternative structures in the mutual fund format. And that's not the kind of environment you would expect to see if alternatives were going to be way that investors were going to diversify their portfolios. And a big reason for this is the emergence of alternative ways to assess or access alternatives. We have, private, we have technology platforms like iCapital. We have the emergence of interval funds, that allow retail investors to access uh, alternatives in new ways. In fact, the iCapital platform, I think, has more AUM than the entire liquid mutual fund grouping. So I think that points to kind of it's a new day when it comes to alternatives and how investors are going to access them. Now, if we look far enough into the future, you know, what we call semi-private or private alternatives will somehow be kind of viewed as public, just as we kind of view today what are liquid alternatives. They always weren't liquid alternatives. We've made them so. That probably does happen over time. Um, so I think there is an opportunity for managers to benefit from the growth of alternatives, but they're going to have to be able to distribute their capability, the opportunity.
Christopher, I could not agree more with you. In the last couple of weeks, I had a lunch with a CEO of one of the largest asset management organizations in Canada, and they were in Canada, and they were mentioning just how successful their illiquid alternative strategy has been with retail investors through their advisory channels. And I think that's, as you pointed out, that, liquid alternatives within the wrapper of the 40 Act funds or mutual fund, 81102, it's one way to get there, but there's just a proliferation and I think a much greater advisor acceptance of alternatives in product wrappers that are not traditional. So I absolutely agree with you, but I think it's a really kind of a good and interesting discussion and opinion. And this brings me back to the topic of the product wrapper. I know you and I talk about this quite a lot. You were one of the early industry experts to really put your vote for actively managed ETFs or non-transparent versions, etc. What do you think about the whole ETF product stream as you look at the future? Do you think that a lot of asset managers or active managers are worried that kind of conversion into the ETF structure might cannibalize their existing fund business? Is that some considerations should active managers be thinking about?
Well, I mean, Steve Jobs famously said that if you don't cannibalize yourself, somebody will do it for you. And of course, he was in a very privileged position when he said that he was thinking about cannibalizing the iPod with the iPhone. If you're cannibalizing a lower profitability product with a higher profitability one, that is kind of a CEO's dream come true. Most business leaders have a more complicated trade-off to make, and I think that's true in our industry. I think the fear is you launch a less expensive active ETF, um, existing mutual fund investors switch over to the ETF, and then you're trading higher fee assets for lower fee assets, and that doesn't make most asset managers happy. I mean, I guess if versus the alternative, you lose the assets altogether. The lower fee uh, option is a more palatable one versus nothing at all. But we did some work for the report to understand whether cannibalization, many major fund providers that have launched active ETFs, and we found no evidence of major cannibalization across any of them. We looked at JP Morgan, Fidelity, Capital Group, which had its first very high profile launch too. And they primarily have been winning business from rival mutual fund providers. And in very few cases, you see investors switching from in-house mutual funds to in-house ETFs. So I think that's um, an overdone worry. That wouldn't be the thing I vote. Um, I think making sure where you can have competitive differentiation versus the entire marketplace is a lot more important. You are entering in a different competitive set, a more limited one. You have less competition in the ETF realm, but people are putting their best foot forward. So your competitors, not competing against your average competitor, you're competing against a handful of competitors who are putting some of their best and most well-known properties and managers forward. So that's something to really think about. I think you also have to be cognizant of your odds of success. I think you also have to be cognizant of your odds of success. We took a look at the odds of a new ETF making it to a financially viable scale within a reasonable amount of time. And you're lucky that if you're a new ETF, if 20%, if you have a one new ETF, if 20%, if you have a 1 in 5 chance, and that's often the best case scenario of making it to $1 million in annual revenues over a 3-year period. The flip side is, and this is, I think, why odds, if you do succeed, you'll get most of the revenues created by new ETFs. And, we know that, especially in the ETF realm, first mover advantages really matter. And that's especially the case if you're somebody like a Capital or Fidelity or any large manager that has a lot of scale and brand equity. They can leverage that and be successful as a new active ETF, even if they don't have the 3-year record. So there's not what has surprised me. You mentioned that we were kind of early in the ETF bull camp, and that may be true. But what surprised me, if you asked me back then, why active ETFs would have taken off, it was the emergence of the kind of semi-transparent ETFs, which allowed active managers to shield their holdings from public view to avoid front running, but while still avoiding the problem of having discounts to NAV and so forth. I kind of thought that was going to be the impetus, and a lot of active managers did too. But we were really wrong about that. It was investors overwhelmingly prefer transparency. It also happened to be that the most successful active ETF of 2021 and into 2022 were the ARC ETFs. They were fully transparent, so much so that the manager was disclosing the trades as they happened on CNBC. And so that created this narrative that transparency and activeness can work. And then when Capital came to market with their transparent ETFs, it really took a DFA as well. ETFs and transparency don't work together. Well, they clearly do, as some of the world's largest asset managers can use them in a transparent format. And the last thing that I would be thinking about is how you're going to go to market. We've seen a handful of large providers like JP moves into ETFs as a way to enter the market. This is not a guaranteed sales. This is not guaranteed to improve your sales. We found no systematic pattern of switching to ETFs making your sales better. So don't do it thinking that it's going to immediately work for you, but there may be instances where it does make sense, where you have a strategy that is not garnering a lot of sales in the mutual fund format, but you have kind of a uniform shareholder base, a base that would be amenable to holding ETFs as the alternative. That was the secret for DFA. A lot of its RIA heavy base very friendly to ETFs, so they probably prefer the ETF over the mutual fund format. So I think that's a consideration that you have to think. But I think the conversion is kind of a limited opportunity, more so than how active ETFs are going to grow in the future.
You talk about the go-to-market strategies for those active ETFs, it's also about figuring out how to make a case for the inclusion of the said strategies in this particular format within the kind of the newly newly emerging and evolving portfolio construction, both by advisors and by investors, as you mentioned before. So I think that this is an evolving topic. As a matter of fact, we just did a large advisor pulse study in our US evolving science of portfolio construction by advisors, and active ETFs are a big part of that upcoming report. So look out for that report. I'll certainly make sure that we highlight it in an upcoming edition of the podcast. Christopher, as always, thank you so so much. Was a very interesting. You know just how much personally I like to think about the future and contemplate the future, and this is probably the most interesting time to be doing just that. As you mentioned, the some of the market and interest rate developments have been just very unique. Maybe this is as interesting a time as when we first started doing this at our predecessor firms in the late 80s and early 90s. Anyone who knows me knows that I'm into very long range ideas, and that contractive wave of the baby boomer generation coming to shore towards retirement, and having driven the growth in the asset and wealth management business in North America for the past 30 odd years. You mentioned that super interesting development, and beyond demographics, we've got regulation. SEC has been busy, as we heard on recently, Eric Pan at ICI mentioned technology developments, and so on and so on and so on. So collectively, all these forces are making it for market forecasters to think about the future. And especially in the U.S., I think it's so intriguing for actually all of our global listeners, because as my great friend and mentor Avi Nakmani used to call the U.S. the world's greatest laboratory of ideas on asset and wealth management, and that is definitely the case. So thank you very much for sharing the preview of this important research on this podcast, Christopher.
Oh, it was my pleasure.
Thank you, Christopher. And that is a wrap us. Thank you, Christopher. And that is a wrap us, everyone. For us in October, I encourage our listeners to come back to join us throughout the fall for our monthly episodes. As always, I also encourage you to ping us with ideas about specific topics or industry guests that you would like for us to feature. This market intelligence. Let's keep our crystal balls polished. The future is fun to contemplate. Thank you.